Hello everybody, welcome to your weekend edition. It is Friday. Cheers to everybody. Happy friggin' Friday. It's just nice to take a breather with all the wildness that's gone on this week in the financial markets. Got lots to talk about, lots of charts to look at, and of course, whatever questions you guys have for us. So I was trying to put together a poll that I thought would be rather interesting, which is why it showed up there and then disappeared. But the poll, as you guys can see it, is, do you think that the U.S. is going to go into recession this year? It seems to be a growing talk track. And as I show more people that chart of the 10-year versus the 2-year, really talking about that inverted yield curve, boy, it really just, it feels like we might be getting near the tail end of the year. But just kind of curious to see what you guys thought. Maybe I should probably keep like a little notebook of the different perspectives and thoughts that you have on these markets and little polls that we take. Ask old Yanet. If I knew how to run speed dial, I would. Well, anyway, cheers. Let me take a sip of this whiskey and we will get started. By the way, today's whiskey, appropriately named Slaughterhouse American Bourbon, which I thought, very appropriate for my expectations going forward. Martini and cigar. Yes. Okay, so let's start things off. I thought I'd have a little bit of fun with the graphic today. Just the roller coasters of the market. I threw a little S&P 500 on the whatever that building is in the background, but for many of you may have felt like it this week as we had kind of huge up moves, huge down moves, just tons of volatility. The overall range for the week, let's put on the S&P 500 because I think that's a little bit better representation. The overall range for the week, pretty good. I mean, there's obviously plenty of trading opportunity for anybody in this market, but when you go from peak to trough, 4.63%, but it was down huge, up huge, and then finishing the week rather poorly as I kind of expected. I just really didn't. I actually thought we'd be down more today. I did not feel like there would be a rally going into a weekend with all the crazy political stuff, the Fed announcement happening next week, and just the other macro global pieces. So no surprise to see a weak down day today, ending near the lows of the session for the S&P, NASDAQ, Russell, and the Dow. But let's start at the bottom, work our way up. So some of the news out there in the crypto space. Oh, thank you, James. I'm happy to do the show. Thanks for still watching. It's been a while. And glad your week ended well, Big Ev. Good. We like when your Fridays end well, that just makes it all worthwhile. So cheers to a good Friday. Yes, so this is a good Friday for me as well. In the equity markets, the crypto not so much, but we'll worry about that in a couple years. Okay, so going to this Bitcoin price chart, you may have seen some of the news today, some of the headlines. There's been, it seems like a dozen different crypto or Bitcoin ETFs that they're trying to bring to market. And they keep getting shot down. They're all pretty much the same, but they're not futures ETFs for Bitcoin. They're spot ETFs, which would be far better for the industry than a Bitcoin futures product. So I'm just kind of waiting for that one to happen. I actually thought you would have seen more development with this, meaning more approval from the SEC since they already approved a Bitcoin futures. But they shot down 2 more companies today, and I think that's why you saw this negativity here on the Bitcoin futures chart, down about 2% on the day. They shot down NYDIG and Global X. Those were 2 that were really looking to get approved. It seemed like there might have been some approval process, but nope, they got shot down. So pretty much all of the ones that have applied to be a Bitcoin spot ETF are now done in the water. So maybe they'll come back and take another stab at it, but I think that's the reason why you saw this last couple down days here as the SEC said, nope, we're not going to allow those Bitcoin ETFs. So we saw a pretty down day for most of crypto. Let me just show you the numbers here. You can see, I've got just tons of red across my screen. A little bit of green at the bottom, but not much. Just a little bit of green. Ripple, surprisingly, up 8% on the day, and Polkadot doing good, up 5%. But most of it, ugly down days. Bitcoin down. Again, the spot is down 1.3. Futures down about 2% on the day. So I'll move up the line here and go from Bitcoin to the NASDAQ, which was down over 2%. And I really wanted it to challenge those lows again this week, obviously, because I am still holding puts. Big Eb says, I bet you exited some puts today. I did not. Did not exit those puts. I will. Next Friday is kind of my point where I go, okay, I'm starting to get a little bit closer to the 60-month or 60-day on those options left, so I don't want to get past that point. So we'll see what happens next week. I do think you're going to see this continue on down. I think we're going to challenge these lows. You see the NASDAQ, I got this little yellow box we've attacked twice already. Which box? This yellow one? Please change the color? Well, what color do you want? I've always used yellow. I'll always use yellow. So yeah, I think we'll challenge this low here on the NASDAQ again next week. Momentum is down. The trend is down. Things just, you've got high inflation numbers. You've got the probability right now of a 25 basis point raise next week. That may actually be 50, but I don't think it's going to happen. I really think it's going to be 25 basis points next week with maybe a little bit more clarity on how many they're going to get this year. You guys might remember last year they said they're going to maybe raise 2 times, and then it was 3. And now as we look at the Fed funds futures, it's priced in 7 rate increases this year alone. So that could certainly have a big impact on the market. But right now that trend is down for the NASDAQ. Technically, I don't see anything here that's that interesting that happened this week other than lots of volatility and targeting a break. If we can get down below these lows, let's say 12,900 on the NASDAQ, then I think you're poised for a nice quick drop down to 12.3, which would be a 600-point decline in the NASDAQ once we break 12.9. Russell 2000 down 1.5%, still toying with that yellow box there. The box is pink? Wow, I'm colorblind, so I really couldn't tell you. That looked yellow to me. This box looks yellow. Let me see. Text, style. It's yellow. That's yellow. That is not pink. You guys, are you messing with me? I'm colorblind. Don't mess with me like that. Anyway, just same thing. Consolidation, sideways chop for the Russell. You might remember we were in sideways action for the better part of a year from 2021 to 2022, and all of a sudden we find ourselves maybe establishing a new sideways choppy range for the Russell 2000. We'll see next week if we can challenge those lows and get below 1900 on the Russell 2000. Okay, next, S&P 500. Love the way it ended, and again, I know my artwork is horrible here. It just I don't want to take this off because I want to see how well we tie or stick to this trend. I'm feeling pretty optimistic. We closed below 4,200 again today, which is good. That's what this red line is here. 4,200 is kind of a psychological number. It's been unable to break that. Now we've closed below it a couple times. Normally what happens is you'll break it, as you can kind of see here. Let me move this line over, just get that out of the way. You can see we broke below it on the 22nd or 24th and then bounced back up. Didn't close below 4,200. Then we closed below 4,200 on the what day is that? The March 8th? Yeah, March 8th. And then the next day we ripped back up. This is normal. It's almost like a bear trap. It brings people in bearish because we close below 4,200. It rips up, squashes them, forces them to take their stops, and then you get the follow-through. So really curious to see what next week brings us with regards to follow-through on this. My guess is as we get closer to the Fed, or actually at the FOMC press conference when Powell is speaking, he'll make the rate announcement. He's going to say 25 basis points increase. That's pretty sure. I'm willing to bet you on that one. A lot of people saying 50 basis point increase. Not yet. They can't start out there, right? You got to start. They just finished the tapering, so let's now jump up 25 basis points, see how that does, see how the world freaks out about that, and then maybe the next meeting, if you have to, you go to 50. But I'm pretty sure we will see comments from Powell pertaining to, or along the lines of, we are keeping a close eye on inflation because of the situation going on in Russia and a lot of the sanctions. We could see significant increases in some commodities and prices that are pertaining to the CPI and PPI index. So I'm guessing he'll say something along those lines, and that could spook the markets. We already know that, right? Jay Powell always blows it in the comments. I love it. It's fun to watch his little train wreck. He tries so hard, but there's sometimes where you can just see him get flustered. And I empathize with him because I know how difficult it is, especially when you're on that big of a stage. Boy, but hey, I certainly enjoy it when he gets flustered because it creates volatility in the market. So that's what I'm expecting to happen next week. We'll talk more about that next week as we get there. But I do love the fact we've had 2 closing days below 4,200. If we can drift down, it makes it more and more challenging to get back above 4,200 because right now momentum is to the south side. Now, Dow Jones Industrial Average was the best performer of our big indexes, only down 0.9%, just barely under 1%. But you'll notice once we get down here, we already came into this area of demand that goes all the way back into March of 2021. After that one's broken, I don't really see any stopping points to, let's say, 31,000. Well, that's a 2,000 point drop. That's a significant decline from here. Well, I mean, not a full 2,000. Call it 1,800, 1,600 point drop from current levels. And the Dow, of course, is one of the most widely watched indexes around the world. So as this starts to drop, or if it does break these lows, I think that ushers in more fear in the global community. So bring it on. Let that fear precipitate. I'll just sit on my couch with my glass of whiskey and say, go market, go. All right, commodities. Here's your gold chart for the day. We actually have a hammer formation. For those that know, we have an aggressive up move with an extremely aggressive down move, and then this long bottoming tail. That is one of the more classical hammer formations. Obviously, I would have preferred this to have dropped more into a strong area of demand. I do have this level mapped out, and you guys might remember from classes at OTA or wherever you took courses that when you have a resistance line or supply zone broken, then it becomes demand. And that's kind of a logical point for us to look at buying into gold. Was this big pullback we saw today? It came right down to the breakout point, tiptoed across it, and then ripped up. So curious to see what the follow-through will be on gold for next week. Again, if Russia does something, or Putin, let's not say Russia, if Putin does something stupid or this escalates, yeah, you'll see these commodities spike up even more. And it wasn't just gold. Here's your SLV on the day. Silver, all in all, was down on the day, but it's already had a pretty substantial run. A little pullback wouldn't surprise me. Drop back down to, let's say, 23.50 and then start to rally from there. Of course, I'm hoping, optimistic, that by next Friday we will be at $23.49 is what I want it to close at so I can keep my silver. Okay, and finally, the big dog, crude oil. So crude oil, I was actually expecting maybe we could see a drop back down to maybe 100 on this one. Didn't really happen today. We didn't get much of a big trading range, although it was up 2.9%. It's funny when this tiny little candle here looks like 2.9%. Wow, then this was much more. Yeah, it was like a 13% swing over here. So anyway, technically, I don't see anything noteworthy here on crude oil. We'll see if this can hold these levels before starting to move back up and make a new high. I think for most of us, we're kind of hoping that this drops significantly. We're looking at $6 gas out here in California. I think someone said $7 up in LA. Crazy to think that prices are getting that high, but it is what it is. Merlin's electronic e-bike store will be opening soon. All right. What else was noteworthy out there today? So there was a bunch of economic data to run through. This is just stuff that happened in the global community in the last 24 hours, but you can see a lot of stuff happening for the British pound. They actually had their GDP numbers much higher than expected. You can see it was expected to be 0.1%. They actually came out at 0.8%. So big bump there for the British pound, although even with good news like that, you would think it would have a nice positive impact on their currency. Here's the chart of their currency. Yeah, it's looking pretty ugly for the British pound against the US dollar. And I think that it's not just that their dollar might be strong, it's just the US dollar, it's not that their currency is weak, it's just that the US dollar is so much stronger, therefore against the pound, it makes the pound look very weak. Now, with regards to where that pound may be headed, maybe I'll have to see if I can get David Warner on the show, because he was very bullish on the British pound for a while. I'm guessing that's changed. This trajectory, this trend is now a downtrend. Lower lows, lower highs, British pound not looking so good at the moment. You could see this thing challenge these 127 marks that we saw all the way back in 2020. It has been some time. All right, what else do I have cooking for you guys? There were some questions that came in. This came in yesterday. I apologize, Alex. I didn't get to it in time. I just scatterbrained and too many things going on. But Alex says, would you say that the drop in oil today is a good buying opportunity? This was for yesterday. But, how can anybody answer that question? Especially when I don't know your style, I don't know your rules. Is it a good buying opportunity? Well, if you think the markets are going up, yeah. If you think crude oil is going to continue to go up, sure. Today would have been a good buying opportunity, or yesterday would have been a good buying opportunity. For me personally, I'm a little more cautious on, especially commodities at this moment, and jumping into something like crude oil, which has had just a ballistic move. You generally don't see moves of this magnitude. And let's see, over the course of 10 days, crude oil moved up 49%. Let's let that sink in for a second. After 10 days, a 49% increase in the price of crude oil. To me, if you're jumping on that trying to buy it, you're chasing. So it's a question of this pullback, where does it come into? And, if this was going to work for you, Alex, and it felt good from a risk management perspective, then go for it. Just always make sure you have a stop loss, because, if Putin comes out and says, my bad, sorry about that, let's all have, peace and we'll all sit around the campfire and hold hands and sing Kumbaya, then crude oil is going to drop significantly if that tension just erodes. So you can never say, is this a good opportunity? What's your perspective on it? I got some people here in chat saying, hey, I'm bullish, I'm long on oil. And others are going to say, I'm short on oil. And we all have different ideas of what's going to happen and how it could potentially move or go. All right, what did I miss? Let me end this poll because I see that it's actually pretty close. End poll. I'm going to put myself in the camp of no, not this year. If it does happen, it's going to be December. It's going to be the very tail end of the year here, but I'll end the poll for everybody. My guess is if we do see recession, it will be next year. And normally what happens with this inverted yield curve, for those who might not know, an inverted yield curve is one of the most reliable indicators of a recession. And I will bring up a chart here that I added to TradingView, which I think is a pretty cool one. Let me see if I can find it. Where did I put it? Where did it go? Right here. Okay, so this is the difference between the 10-year and the 2. It's taking the 10-year and saying, let's subtract the 2-year Treasury. That's generally the measure of the yield curve. And they'll say if it's normal, the 10-year is much higher than the 2. If it's flat, the 10-year is just about equal to the 2. And if it's inverted, the 10-year is going to be less than the 2-year, meaning the yield. So if you look at this chart, what it's showing right now is we had back here in this period right there, going into 2021, from 2020 to 2021, the 10-year was paying you about 1.5% more than the 2-year, which is what it should do. That's a normal yield curve. But then all of a sudden, I mean, we're talking an aggressive sell-off, and here we are right now. The 10-year is paying you 0.25% more, 0.25%. And you have to ask yourself, if I'm going to commit money, if I'm going to lock up money for 2 years and get, let's say, 1%, is it worth it to commit my money for another 8 for 10 years and just get 0.25% more? That's that flattening yield curve, and it basically is a sign that in the future, it's not looking so bright. So what we'll be watching this, I'll keep this one as kind of a regular for the show going forward. Of course, I'm going to be gone for about a week here soon. But we'll keep watching this one. And this green line down at the bottom, that's the zero line. That's really what we're looking at. If we get below this zero line, that's one of the indicators we're going to go into recession. It basically means we have an inverted yield curve. Last time we had one was August of 2019. And of course, some would say, well, we had the recession with the COVID pandemic. Okay, well, it worked, right? Well, if we do get a breakdown below the zero line, let's say it happens by March, April, somewhere in that ballpark as they start to raise rates, normally it's about 9 to 18 months lag time. So once we get that inverted yield curve, map out like kind of 9 months on your charts there and say, okay, that's when things really start to fall apart, where you see the real impact on the market. So just something to keep our eyes on. Obviously, there's tons of information to follow, but that inverted yield curve is one that's becoming very interesting as we are getting closer and closer to being inverted. Now, Bill Addis will be on the program next Thursday to talk about that inverted yield curve and kind of how we capitalize on that. We heard a bearish bunch. It's funny you say that, Big Ev. I think we just need to change our perspective. So when people say we're bearish, I'm not bearish. I'm just bullish to the downside. So, people are, you're a perma bear. I'm not a perma bear. I've definitely seen more justification for these markets selling off, but the markets have proven me wrong. So I'll just keep grinding away on the shorter term stuff, and hopefully this next trade does really well. Alvin, how does a recession affect the housing market and housing prices? Well, if you think of it as a downward spiral, right, there's always going to be that first domino that falls. The question is, what's the first domino? Well, if you look at what the Fed is going to do next week, they're going to raise 25 basis points, which is going to have a direct impact on the 10-year. Now, let me bring up the 10-year chart for you. Here's your 10-year, and this is what most mortgages are based off of. Now, some are off the LIBOR and different benchmarks, but in the U.S., most likely your mortgage is tied to the 10-year. So you can see back here in 2020, you could have gotten a much cheaper loan. And we've seen that price chart. I've shown that to you guys, and you can see that the sharp increase. Well, right now we're just about back above 2%. And if they raise rates next week, that could push us up a little bit higher and maybe start moving towards 2.1, 2.2, 2.3. So to answer that question, how does it impact the housing market? The higher that these interest rates become, the harder it is for people to qualify for loans. So if you pulled out $100,000 paying, let's say, 3% interest, you might be able to make that with your current income. But if all of a sudden we're at 4% on that same $100,000, it could be much more challenging for you to make your PITI, which is property taxes, insurance, etc. So, and in property tax, insurance, and property tax insurance, and primary interest payments. There you go. What happened to Tilly Allison? Nothing happened to Tilly. She's just, she couldn't come on the show because she works for a company that doesn't want her doing social media things. And I think that may have changed. So I'll see if I can get her back on. Tilly, obviously one of my favorites to come on the program. So when we talk about dominoes and this downward spiral, and this is just my perspective. I could be totally wrong, and many of you probably think that I'm wrong. That's okay. But when you have the rising rates, it puts a little bit of a crunch on the housing market, right? It makes it harder for people to buy. So what happens is you start to price people out of the market, and this insatiable demand that we see for real estate, which is just skyrocketing, will start to subside. When that happens, then you're going to get some people who have been buying and buying and buying, like I made the example of the Las Vegas stripper buying 18 houses and not really having any real income to pay for it. Once you lateral loan these things and one of them misses, then they can all come crashing down real quick, which could put us in a situation probably not as extreme as 2008, but it can set up that situation where a lot of people start to go into foreclosure. When that happens, no longer will we have a supply shortage. It seems like right now the issue is we have a supply shortage in real estate and everyone's trying to buy and there's not enough homes. It could be where it starts to flip and all of a sudden we've got tons of homes because of foreclosures and people not making it. That's one piece of that domino. The other piece is, and I think this is probably the more realistic one that's going to happen right now, and you guys let me know what you think, is the unemployment numbers seem so rosy, but you're looking at under 4% unemployment, which by anybody's stretch of the imagination would be considered full employment, but that's the U3 rate. The U6 rate is almost double that. I think it's like 7%, maybe in the high 6s, low 7%. But that does not include the people who've just stopped looking, right? Labor force participation rate is just dropping and dropping and dropping, meaning people just stop looking. So now you have the situation where we might start to see the economy suffer a little bit from rising rate environment, from sanctions, from just all these issues that are facing us right now. And then all of a sudden, companies start to lay off again. If they start to lay off again, then all of a sudden people start to miss their housing payments much quicker than before, and the spiral starts to accelerate. So that's kind of my take on it. How does it affect housing prices? I think housing prices, you've got probably another 6 months to another year, right? Another 6 months to a year of prices moving up. Maybe not a year. 6 months, I think, is your window where if you're looking to sell, it's the golden time to be a seller right now. Absolutely. I sit there just every day kind of question myself, like, should I sell this place? Should I sell this one? I just don't want to go look for a rental property and with my German Shepherd, and it's just not going to happen. So I think ultimately we'll put pressure on the housing market. And when we look at something like, let me see if I can bring up the Case-Shiller Composite 20 Home Price Index for you, just because that's a great benchmark or a great reference point. I'll go up to Forex Factory here and pull up the economic data. We'll go to calendar, just so you guys can see that chart. It's been pretty, let's go none, put the US, and we'll go none and look at housing. And I want the Case-Shiller Composite 20, which I think was 3 weeks ago. There's your Case-Shiller Composite 20 Home Price Index. You look at this chart right here. That should be a warning sign. I mean, this is a very, 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 very aggressive curve. I mean, that is way too much. In 2020, we were looking at about 3.8% year-over-year growth in real estate, and that was in August of 2020. And just a few months later, by let's call it September, so 13 months later, we're at 19.7. If you're a property owner, this is awesome. You love it. But you know this can't be sustainable forever. Even looking back into 2007, we didn't have those peaks. So that makes me a little bit wary here. And Joe's right. Mortgage forbearance program really puts supply in a bind. Yep, who would have thought? So the forbearance basically said, you don't have to worry about your mortgages. We know that COVID's going to be an issue. You're going to potentially lose your jobs. We'll help you out and let you miss some payments. Of course, it's added onto the back end. It's not like it disappeared, but I think that could have a big impact on it. When the safety net is removed, then I think we start to see some more problems. I hope we don't. Personally, I hope we don't, because that just means that a lot of people are going to be hurting and losing their homes. But as I mentioned yesterday, I do my best to help people out. But bottom line is I got to help myself out. And if I've got cash and I see the housing market is at a real low, a good buy point, I'm going to buy, regardless of what happened to that house or the previous owners of it. So, Batista, the Fed need to raise rate 37 times by 25 basis points. Well, we don't know. Again, this is one of those things where we have to test it out, right? You start to raise rates, and then you start and you start. And personally, my belief is raising interest rates doesn't help. It will help a little bit, but the issue is the sanctions on Russia and all the supply chain disruptions and commodity disruptions that are going to happen there. To me, that is the real danger part for all of this. So we'll be raising rates, and we're still not going to get that 20% of the global supply of wheat back. Anytime the government screws with the natural order of things, there's pain down the road. Yep, absolutely. And I've been saying this for over a decade, which is when you juice the system this much, when you just slam that pedal to the metal, it reminds me, I think it was a Castro GTX commercial, right? It's an oil commercial, and it says, you better do something to your car before it does something to get you heated up. And it shows the car redlining, and then the engine just blows. That's where we're at. We've been holding that pedal to the metal for years now. Since 2009 is really when it was just full-on acceleration. Anyway, let's see, what else do I got here? Tesla didn't do much. Well, I don't follow Tesla on a daily basis, but why not, since it's Friday and we're here and I got a glass of whiskey in front of me. Didn't do well at all, down 5%. And if I don't remember correctly, Northside, I think you're one of the guys that's like actively trading that bad boy. Here's your Tesla for the session. Pretty ugly day, and again, this is the same basic trend we're seeing. Is lower lows, lower highs. As much as Tesla, it seems like it's just this Goliath in the industry of EV. Remember where we came from. I mean, it seems crazy to think of where we were just a couple years back. In 2019, this is a $32 stock. And it reached up over 1,000. I mean, this looks like a cryptocurrency right here. Well, some pullback may be in order. Some correction may be in order. Although, it is Elon Musk. I'm not betting against Elon Musk ever. Ever. All right, let's see. What else do I got? Siraj, it's been a time since Tim Pesci came on the show. You know what? I reached out to him a couple times, and he's always seems to be busy, but I will do my best to get him on the program. Okay, more questions. I'm going to go this one from Juan. He says, from a technical analysis point of view, at what point do you think bullish traders will change their mind? I'm fairly new to trading, 2 years, and I can't understand why some traders are still bullish on the S&P and NASDAQ and thinking that this is just a correction. We are below the 50 and 200 period moving averages. We dropped 14% on high volume in a few days. My assumption is that the only way you can be bullish is if you ignore all the economic data and the events that are happening and only consider what is in the chart. And there is probably something there that I don't see. So I think the reason that you have perma-bulls out there, it goes back to the fundamentals of how markets are created. Markets are created by really indexes, and they're designed to go up over time. Markets are built to go up over time. So the perspective is, I'll just keep holding it. The longer I hold it, the more likely I will ride out any market downturns, and I will ultimately have a profitable trade if I just keep on holding it. Now, I agree with that 100%. But what I don't agree with is anybody buying, let's say last year in let's say December, as we're peaking out there, you're buying at all-time highs. So that's a risk. I'll bring this back up here. So let's say, you're buying back here in November and maybe early January, December and early January of 2022. You're buying after this colossal move. That the probability is that it's going to have a retracement. So fine, I'm looking for some short opportunities. So when it does pull back, it could still maintain a bigger uptrend. Let's just go weekly here of the S&P, right? Looking at this chart, where would be a logical place for it to come back to? Like, where would I be happy being a buyer? Maybe at 3,500, right? Being a buyer at that point, fine. Merlin, what were your grades in college? Not very good. Not very good. I almost feel like I had ADD at one point, and I just couldn't focus. I also, as you can see, because I just got ADD from that question and switched topics. But I also felt like some of my professors were idiots, so I just wasn't apt to learn from them. I had one guy, it was my finance, it was a trading class, like a market trading class, and he goes, okay, what's your last name? I said, Rothfeld. He said, okay, everybody in the class, you can only buy stocks. I need you to build a portfolio, but you can only buy stocks that start with the first letter of your last name. I was like, that's stupid. There aren't really many great companies that started with R back then. Anyway, it just clear this guy didn't know what he wanted. I actually went back to my alma mater and said, listen, I'd be more than happy to come in there and talk to the younger generation about the technology and what's changing our trading world. And they said, no, we don't want that. I said, I'm not going to charge it. I'd rather they need to know that direct access trading and, these electronic marketplaces are going to be the future. And that was in 1998, 99. And they still said no. Fools! Okay. I see a big head and shoulders in the trade. Yes, you do. That's mine right there, buddy. I'm hoping that one comes through. I'm actually not hoping. I hate the word hope. But yes, that's a weekly head and shoulders. And there's my target. And it may seem like a long way down, but again, when I zoom out here, does this look like a long way down at all? If you go back to where we started in 2009, does this pullback, my target right there at 3,600, does that look like a massive correction? It really doesn't, when you look in the grand scheme of things. So at some point, to answer question one, there's some people that you will never convince, or not convince, but that will never be bearish. We actually had a guy who used to watch this show. I think his name was Unscammable. His name was Unscammable, was his name on the screen. And it didn't matter what I said or what I showed. It was like, buy the market, buy the market. Markets always go up, always go up. And I'm like, over the course of a millennium, yes, you're right. But over the course of the next 3 months or 6 months or year, you could be totally wrong, and you could lose 50% of your portfolio in that amount of time. So let's not be overly bullish. Let's be, opportunistic and be bearish when the markets dictate. So, there are some people that will always be bullish no matter what. And again, there will always be people there will be people who are always bearish at the same token. So that's why trading works. Is someone's always wrong and someone's always right in those equations. There's, when you have a buyer and a seller, here's the beautiful part. So Thomasina just said, just jumped on there and hi, Thomasina. If Thomasina is bullish and I'm bearish and I buy the shares that she's selling, one of us will be right. Now the question is, can we both be right? If Thomasina sells me shares, let's say it's Apple shares, right? So Thomasina sells Apple shares to me and I buy her Apple shares, can we both be right? Absolutely. So let's say Thomasina felt the markets were going to go down. So she shorts Apple, but she's on, like, say, an hourly chart. So she shorts Apple for, let's say, the next 2 weeks. No, Apple drops for 2 weeks. She buys to cover. She makes money. I'm still holding long my Apple shares that I bought from Thomasina. It drops for 2 weeks, but then all of a sudden, over the next 6 months, it rallies huge, and I sell for a profit. We can both make money. But at that moment in time when that transaction is made, people think one person's going to be right and one person's going to be wrong. And that's not true. It depends on your time frame. If you each get out on the exact same day, then someone's going to be a loser out of that equation. But it depends on our objectives and targets. So, in one, don't worry about the bullish people. You worry about your own trades. You know what I mean? You got to build your own character, follow your own rules, and make sure that you don't put yourself into harm's way. And if, we'll all put ourselves in harm's way in the financial markets. Usually it's going to be a small amount, right? Maybe I would risk $100 or $1,000 or $10,000, depends on your portfolio, but never get to that point where it could blow your account all the way. Okay, fun. Now I got more questions coming through here. So hopefully I answered that one for you, Juan. I'm going to go to this one real quick, and then, Joe, I'll get to your question after I have the sip of whiskey here. Slaughterhouse. Come on, markets. Tank, I need some big down days. This is from Jeremy. He says, was curious on your thoughts regarding housing. My wife and I bought our first home in 2015, and we're up 140%. Well, that is great. At the end of the day, I know they're only paper profits. The trader in me says sell, rent, and wait for the market to come back down. But even rents have exploded in our area to try to find something to fit my family in and for how long. Our real estate agent, who has been in the business for 30 plus years, says that according to their analysis, our market here, the next in Raleigh-Durham area, could stay inflated for the next couple of years due to growth we are seeing. Okay. First off, my father's a real estate agent as well. And he is, my idol with regards to real estate. Taught me everything I know. He is phenomenal. I think he's the best real estate agent. I know he's the best real estate agent I have ever worked with. Most of them are just hacks trying to get the deal. My dad's a worker. I will say that and also tell you that his perspective is almost always bullish on the market. Almost always. It's like asking a gold miner and saying, hey, what's your thoughts on gold? Do you really think a gold miner is going to go, gold's tanking. You should sell your gold, man. There's no future in it. It's done. I'm a gold miner. I have to convince you to buy. If you look at, if you went to let's say you go to your favorite restaurant in town, and your waitress is not there, but the owner is now your waiter, right? And you go to the owner, say, hey, how's the chicken piccata here? He's like, oh, it is the best chicken piccata you're ever going to have. It's so good, right? The owner of that restaurant's not going to go, I'll be honest with you, our chicken piccata's crap. Tastes like total dirt. I don't even know who's making it, right? They're always going to try to sell you. And a real estate agent needs you to be buying and making transactions. So that said, let's not bash on real estate agents. I think you have to look at the trends. And for me, one of the big things that I see in the equity market, so let's take a stock, for example. If you have a stock that has a nice trend, great, that trend will probably continue. But as that trend becomes more elevated and the amplification, the steepness of that curve starts to just go parabolic, to me, that's the beginnings of a warning sign where you got to go, ooh, when things go parabolic, that's usually speculation running rampant and people spike up like that, and markets spike up like that. So, if I haven't looked at Raleigh-Durham's, price trajectory over the past year, but I'm willing to bet you it is absolutely spiking right now. I know people always speaking highly of Raleigh and Durham. North Carolina is popular. I mean, there's a lot of places that are really booming. The question that I would have for you, Jeremy, if I was in your situation, and you got a family, you got a wife, I don't know how many kids and how many dogs, cats, whatever, but you bought your home, you've now been in it since 2015, so you've got 7 years in that home. If you're comfortable and you're happy with it, and you go, this is the house that we wanted, and we're going to stay in this house, then just stay. Doesn't matter, just stay, regardless, right? But if you guys are thinking maybe, we'd like to move to a different area, maybe want to upsize or get something with a pool, and you got all these different considerations, and this is not your perfect home, then maybe you do sell high. The question you have to ask yourself is, how much is this market going to drop, or how much could it drop? Could we see the housing market drop 50%? We could. I don't think that's going to happen. I don't think it's going to be anywhere near as significant as it was in 2008, 2009. I don't think we'll see that type of decline. However, it's been a very long time since we had a major market correction. And I feel like the markets are just about to drop it on some. I mean, we're due. We are long overdue for one of those monster corrections that we can write chapters and textbooks about. I always poke fun at this chart right here where, these two yellow boxes, those are historic, absolutely historic events in our textbooks. That's the dot-com bubbles on the left and your financial market crisis in the right one. Well, when you put that into perspective as to where we are today, it's nothing. So to me, it's just setting up for something huge. And, I'm hoping that I'm short when it happens. I'm in the same situation as you, Jeremy. I've got this house. It's actually too much house for me, I'll be honest. It's too big. I don't need this big of a house. It's ridiculous. But when I bought it, I got the best deal on the planet. So you have to make that assessment. You have to say, and again, Diana Hill, who was one of my kind of real estate gurus as well, she has all these spreadsheets. And when you line up the spreadsheets, fill them all out with all the variables and say, okay, here's what I'm paying now. And mind you, put everything in there. So you have all the numbers written down so you know exactly what your nut is for your property. And then you look and say, okay, where else am I thinking of moving? Maybe I want to rent for a year or 2 years. How much is that going to cost me, right? Then you start to say, is this a realistic opportunity for me to sell at a high price and then come back and buy lower? Now, I don't know. I'm pretty sure this is a federal rule. I don't know if it's just California. I'm pretty sure it's elsewhere. But if you live in your home for 2 out of 5 years, I believe it's 2 out of 5 years, you get 100. If you're single, you get $250,000 tax exemption on the gains. If you're married, you get $500,000. So you could have pretty much tax-free gains on your property depending on what you paid for it. Awesome, right? That's great. There is no way for me to say, sell your house, buddy, dump it. It really depends on you, your area, how happy you are where you're at. I had a couple friends that bought their home back in 2006, and they paid a huge amount for it. And I was kind of like going, you know what? You sure you want to pay that much right now? You're chasing the market. And they go, we love this house. We're not going to move from this place. We love this house. This is the one we want to have for the rest of our lives. I said, fine. As long as you know you can make that payment, great. But, California is getting a little expensive. Plus, I wouldn't mind moving closer to my father. So who knows if we end up pulling up and selling this place. I'll let you know if I end up selling the house. If you guys want to buy it, cash offers accept. I'll accept Bitcoin as payment for my house. Anyway, Jeremy, there you go. Northside says, I have no idea why Interactive Brokers always fills my orders partially. With other brokers, I have seen people with 15 and 20K get filled right away. I'm not a fan. I was a fan of Interactive Brokers, but their platform was just kind of clunky and weird to me. I went there because they were really cheap, but I'll be honest, I don't even use them anymore, so I can't tell you why they're filling your orders awkwardly. Shouldn't happen. Sounds like you're going to be selling. I honestly no, Big Eb. Right now I'm probably in the 10% yes that I'd be selling it. So that's a 90% no. I haven't had the time to sit down and really map out everything, because what I need to do is I need to have a house with a studio so I can do broadcasting and everything from there. I need to have at least 3-bedroom. I also need to have a yard for my dog. So those are considerations, and I have to map out what that cost is. But man, there's a house down the street. It is, I want to say 1,300 square feet, newly remodeled, 3-bedroom, 2-bath. Just, they put it on the market, and within 2 days was in escrow for 1.35. I'm like, 1.35 million for that? Mine's considerably bigger than that. So why not sell it when you can? Would you comment on the length of bull versus bear markets? I've heard bulls have historically 7 to 9 years, even though when there's unprecedented. Yeah. Bear ones are really short. I mentioned that the other day. It's like, you have basically two stories here. The first one is bull markets. Bull markets, I agree. 7 to 9 years, 6 to 9 years is really kind of that sweet run. And then your bear market's going to be like a year to 2 years. So when you look at the math equation there, wow, go long because you have much more growth potential. The difference here, though, is in the bull market runs, typically, you get this years of slow growth, and then in the bear market, you can erase all of that in 2 years. So that's the joy of being bearish and being on the short side, is things, when they happen, they can happen very quickly. Now, when we look at this overall equity market right now, it's kind of hard to think of, like, how quick is this thing going to sell off? If it rallied that quickly, my goodness, this sell-off could be an absolute black swan event and just come crashing down. I don't think we'll get that. I'm just saying the law of averages is typically bull markets are slow, methodical, and they keep on going. Bear markets are short but extremely aggressive and deep sell-offs. Northside, time frames I prefer are 5, 10, 30, hourly, and daily. Find the pattern on the bigger time frames, then enter trades based on the 5-minute charts. So you're a short-term intraday trader, right? Or you're a short-term intraday or swing trader, right, Northside? Because I would say I'm right there with you. I don't use the 10, so I use a 5, 15, hourly, 4-hour, and a daily. Those are my time frames I'll have on my screens. And I don't need all of that, but I have a 3-screen setup, so it's easier for me to look at those different time frames. For me, that is generally going to be if I'm day trading or maybe doing some swings. If I'm looking longer term, I'm not going to go down to a 5-minute chart. If I'm looking to make, positions or longer term swings, I'm not looking at a 5-minute chart. But to each their own, and I agree with. I think your setup's fine. Let me see, Joe. Are all stablecoins equally stable, or is there one way to compare them? In that sense, looking to stake some and want to do my due diligence. Well, damn howdy, you better do your due diligence, Joe, because they are all different. They're all different. And unfortunately, you're going to take me down a rabbit hole here that could last an hour because, as most of you know, right now at this point, I would say crypto is definitely a passion of mine and understanding all the details. Because of the Crypto Investor Live program that I host, I do 4 hours a week in that CIL program. I've immersed myself in it. I'm digging deeper and deeper every day, finding out crazy new things, new technologies, projects. It's a lot of fun, but it is a rabbit hole for sure. If you are interested in crypto, actually, I think down in the comments below this video, I have a free, it's like 6 or 8, I think it's 6 videos that we did for Online Trading Academy that are free to you. Just click down that link there below. So let me just tell you real quick the basics. We'll do high level here. Some of you might not know what a stablecoin is. A stablecoin is simply a tokenized instrument. It's basically a digital asset that is pegged to something. So we could create an asset that's pegged to gold, to silver, to the ruble, whatever, and that could be considered a pegged asset. With a stablecoin, they're usually pegged to a fiat currency. So in most cases, most stablecoins are pegged to the US dollar. Now, within that, there's 4 different types of stablecoins. You have one that is straight backed with a fiat currency, meaning one token is $1, and that $1 is sitting in a bank account and it's audited by somebody. Right? That to me is the safest form of stablecoin because it physically has the money sitting in a safe somewhere. Most of them don't do that. Most will do one token or one stablecoin equals They have some money in cash, but the rest of it is sitting in treasuries or bonds. Then you have the extremes like Tether, who has one token, should have $1 in the bank, but they don't. I think they have 7% of the $80 billion is actually cash. That means that 93% is something else. And they're using corporate debt, which is greedy because they're getting a higher rate of return on that, but they're also putting themselves in a very precarious position because should any of those default, that's going to take a hit to the stability of your stablecoin. So personally, in my opinion, stay away from Tether, right? That's like going to a crackhead and saying, hey, I want you to watch my house for the week. Bad idea. So those are three that are kind of fiat backed. Then you have algorithmic stablecoins like DAI or what's another good one? UST, where it's just programmed. It's basically a computer program is increasing supply or decreasing supply depending on supply and demand so that it stays at about $1. So those are the main two. You've got algorithmic and then you have fiat backed. Some are commodity backed where it'll have $1 equals X amount of gold or silver. That's kind of cool as well. Those are the main ones in the crypto space. Make sure you do your due diligence because they are absolutely not all created equal. As you dive into them, from a safety perspective, I would only buy the ones that have audited their books. Tether hasn't been audited, and they're like, oh yeah, we have this. That is some scary crap. Those guys, to me, are making up stuff. Plus it's China, plus it's run by Bitfinex. It seems like real shady stuff going on with Tether. But with something like USDC or TrueUSD, PaxosD, these are a little bit better because they have been audited. Some are audited by more reputable firms, but to me, you've got to have audits. I want to know that that's backed. Once that happens, then I feel comfortable, let's say USDC, for example. USDC owns some cash, but also a bunch of treasuries, which is short-term bonds. And the reason they do that is so they can earn some money on those deposits and pay themselves. Fine. I'm okay with that. Treasuries, I'm all right with. So once you have that, you could take that stable coin and now move it over to different brokerage firms and I've seen upwards of 20% interest on stable coins. So shop around, as this market starts to drop, or if it starts to drop, where do you want to park your cash? You want to keep it in dollars as we get hyperinflation going on? Probably not a good idea. There must be something wrong with me. Even when I'm sleeping, I dream. No, Northside, it's funny you say that. I used to joke with my... It's really funny that you say that. When I used to teach the core strategy class for Online Trading Academy, there would always be somebody who's like, I just eat, sleep, and think trading and nonstop. And I said, listen, let me just tell you, when I go to the grocery store, and you're never going to unsee this, Northside, and anybody here, you're never going to be able to unsee this once you go there. You walk through the produce section, and the way they stack the produce, especially like the apples or the carrots, it makes price charts. And I walk by I'm walking by the navel oranges the other day, and I'm seeing a head and shoulders pattern on the navel oranges. I'm like, okay, I need to go grab a bottle of whiskey. This is too much for me, but I see them everywhere, my friend. Don't worry, I see price patterns and everything. I'm looking out the window and I see this. It actually looks like a dog in the tree over here, but yeah, I see price patterns all the time. Once you train your eye to see them, you see them all the time. All right, sorry, I'm making myself feel like a sociopath right now. Let's see. I need to wrap up because I got to get out of here. It's Friday. As far as it goes for Monday, there really is nothing pressing on the economic front for Monday. There really is nothing pressing for the earnings front on Monday as well. So it's going to be kind of a quiet day. If you are looking at, let me just remove this filter here real quick. If you're looking at the overall markets and news, nothing's really happening till next week. I mean, it's all about later on in that week. So the exact announcement, I'll bring it up right here. We'll look at this one. There's your USDC. I actually messed up on it's Wednesday. I put Thursday down. It's Wednesday will be that FOMC announcement, and that is going to be at 2 p.m. For some reason, I thought it was Thursday, but it's usually Wednesday anyway. That's the big one. And I expect the markets to be rather quiet Monday and Tuesday, really in anticipation of what happens on Wednesday. So would not surprise me to see Monday, or actually Sunday night when futures markets open. I'm guessing we're going to gap down as we have for the past 4 weeks. We'll have a gap down on Monday. potentially a rally on Monday, but I don't think it's going to be severe. I think you'll see a lighter volume Monday and Tuesday, and then when Powell says what he has to say on Wednesday, all hell is going to break loose, and we'll see this thing go kind of crazy. So it should be fun. Tom, you asked me something too, and I told everybody I would get to those. So one sec, I'm going to answer one more question here for Tom, since he asked that one, and I have to go to YouTube to get to this one. I told you I would answer the questions that came into the YouTube channel, so let me make sure I get these ones, and bear with me. Tom, you sent it at the very end too. He says, bad news can always be factored in. I worked with an old German engineer who put TIF in his project schedules. There are always unforeseen issues in projects, so he had time scheduled for things I forgot. Why doesn't the FOMC just schedule a 0.25% increase in interest every quarter? Schedule the bad news. Well, why don't they schedule 50 basis points, right? Why don't they ramp it up even more and more and more? I don't know. At this point, I think that they don't want to spook the market. I think if they said that they're going to do 8 meetings this year and they're going to raise 25 basis points every meeting, what does that do? That tells the entire world that for this year, the U.S. is in deep doo-doo. So they don't want to tell, right? They'll telegraph what's going to happen slightly for the next meeting. He's pretty much set the stage for 25 basis points. If he did 50, boy, if he does 50, Monday we're going to see my puts are going to do real well if he does a 50 basis point increase on Monday. Come on, Powell, do it. Surprise everybody. Right now there's a 95.1% chance that he's going to raise 25 basis points. 4% chance he does nothing. No chance, according to the futures, that he's going to raise 50 basis points. All right, that will do it. So I will see everybody on Monday. Tomorrow, let's see, what's Monday? Next week, we've got some great stuff happening. Tuesday, I'm going to have Dan Roberts on the show. Thursday, I'm going to have Bill Addis. I'm going to try to get some other guests on the program, and that's going to be kind of the last week. After that, I'll probably do a show on Monday the following week, and then I'm on vacation to Aruba. So there you go. Fear for the unknown is the problem. Yep, fear of the unknown. Exactly. And it's not the problem. It's what creates opportunity, right, Tom? The fear of what happens in December. We all know what's going to happen Wednesday. We know what the announcement's going to be. No one knows what the economy's like, what the world is like, what Russia and Ukraine and Canada and Mexico, what's going to be like in December. We have no idea. And that's why we trade. Because we are trying to anticipate that. And if we're wrong, we have small losses. If we're right, we take big winners. All right. That's it for me today, everybody. Hope you enjoyed. If you have comments, do me a favor, put them down below the YouTube video. Just go to TraderMerlin on YouTube, type in or click on today's video, which is called this wasn't inflation. This is the weekend wrap up. That's right, Trader Week wrap up. Put your comments down below the video. I'll get to all those on Monday's session. I hope you all have a fantastic weekend. Go do something fun, spread some love, give some people some hugs, and live our lives. That's what we're here to do. I'll see you guys all on Monday. Take care.